Welcome, curious minds, to the deep dive. Today, we're plunging into, well, a really foundational topic for anyone in finance and auditing.
Absolutely.
We're talking materiality, risk assessment, and internal control. And look, if you're gearing up for a case-based exam right now, this deep dive, it's pretty much custom made for you.
That's the goal.
Our mission today is to really distill these key concepts, make sure you're comfortable with the exact language, the terminology you'll see in your source materials. We'll look at real-world examples and even walk through an integrated case study, the kind you might actually face.
Yeah, this isn't just about theory, it's about applying it.
Exactly.
Yeah.
Practical knowledge you can use. Okay, let's unpack this.
And what's really fascinating here, I think, is that getting a handle on these concepts, it's so much more than just passing an exam.
Oh, for sure.
It's fundamental. It's how you understand financial statement assurance, business integrity, how companies actually function effectively day to day. So the plan is start with audit risk, then delve into internal control systems, and then the really fun part, jump into practical application. That's where it clicks.
Those aha moments. Let's do it. All right, let's start right at the bedrock. Materiality. How would you describe materiality? Not just the definition, but like its role for the auditor. SA 320 puts it everywhere, right? Planning, performing.
Yeah, it's like the auditor's North Star guiding everything. Materiality is basically the threshold. Below it, misstatements, whether one big one or lots of small ones added up, probably won't change the decision someone makes based on those financial statements.
Okay.
And like you said, SA 320 stresses, we use it all the time when planning, doing the work, evaluating what we find, and crucially when forming our final opinion. It's not static, it's very much context dependent.
So if it's dynamic context dependent, how does an auditor actually figure out the right benchmark? What goes into that judgment?
Good question. The standards give us pointers. You look at the financial statement elements, P&L, balance sheet. What do the users care most about? For a stable, profitable manufacturer, profit before tax might be the go-to benchmark.
Makes sense.
But say a construction firm losing money because of a pandemic, profit before tax is useless there. Users might look at revenue or maybe gross profit just to see the scale of operations.
Right, the activity level.
Exactly. Or think about a public utility program. Maybe total cost is more relevant than profit. It always comes back to what matters to the decision makers using these statements.
Got it. It's user-focused. But then there's performance materiality. SA 320 brings this in.
Right.
Why set an even lower amount? It feels like being extra cautious.
It is being extra cautious, but for a very specific reason. It's about creating a safety net, a buffer. Performance materiality per SA 320 para 9 is set lower than the overall materiality level. Its purpose is to reduce the odds that all the little undetected or uncorrected misstatements, when you add them all up, don't accidentally breach the overall materiality threshold for the whole set of financials.
So it's catching the cumulative effect of small stuff.
Exactly. It's preventing death by 1,000 cuts, you could say. We're not just looking for the one huge error. We're making sure a swarm of tiny ones don't cause the same damage. And it's not just plugging a percentage into a formula. It requires real professional judgment, thinking about the entity, what we found last year.
That's a great way to put it. And that whole idea of materiality and the potential impact of misstatements leads us right into audit risk, AR. The auditor's biggest fear, right? Getting it wrong. What does getting it wrong mean here?
It's the nightmare scenario. Audit risk is the risk that we, the auditors, give a clean opinion saying the financial statements are fine when actually they contain a material misstatement. We give the thumbs up when it should have been a thumbs down. Our whole job is about minimizing that risk. And we have this sort of model, a relationship. Audit risk, AR. Inherent risk, IRX. Control risk, CRX. Detection risk, DR.
Right. The formula. Let's break that down.
Okay. Inherent risk, IR. This is the raw risk. The susceptibility of an account or assertion to misstatement before you even consider any controls the company has. It's risk that's just inherent in the business or the transaction.
Like what?
Think about tech. If technology moves super fast in an industry, the inventory is inherently risky. It could become obsolete quickly, meaning there's a high inherent risk of inventory being overstated. That risk exists regardless of controls.
Got it. Raw vulnerability.
Then control risk, CR. This is the risk that the company's own internal controls won't prevent or catch and fix a material misstatement in time. The risk their safeguards fail. And importantly, there's always some control risk. No system is perfect. People make mistakes. Controls can be overridden. Well, we'll talk more about limitations later.
Okay, so inherent risk is the baseline risk. Control risk is the risk the company's systems fail. What's the last piece?
Detection risk. DR. This is the risk that our procedures, the auditor's work, won't detect a material misstatement that actually exists and that the internal controls missed. It's the risk we miss it.
Right.
And the crucial thing here is the inverse relationship. If inherent risk and control risk are assessed as high, meaning the business is risky and its controls are weak, then we need to set detection risk low.
Meaning
We have to do more audit work, more rigorous procedures to minimize the chance that we miss something. Low detection risk means high audit effort.
that makes total sense. Let's try applying that. We have this scenario, test your understanding 7. It says, if there are chances that 40% bills of services would be defalcated, IR 40%, and internal control can prevent 75% of such defalcations, CR 25%, and auditor's procedures give 60% detection satisfaction, DR 40%, calculate the overall audit risk. How would you walk through that for, say, an exam setting?
Okay, good example. First step is always calculate the risk of material misstatement, or RMM. That's IR times CR.
So inherent risk is 40%.
Right. And if controls prevent 75% of that, it means 25% gets through. So the control risk, the risk controls fail, is 25%.
Okay, 40% times 25%.
Which equals 10%.
Yeah.
So our RMM is 10%. That's the risk a material misstatement exists before we even start our specific detection work.
Got it. RMM is 10%. Now what?
Now we bring in detection risk. The scenario says our procedures give 60% detection satisfaction. That means there's a 40% risk they don't detect it. So detection risk, DR, is 40%.
Okay.
So overall audit risk is RMM times DR. That's 10% times 40%.
Which is 4%.
Exactly. 4% is the overall audit risk in this specific scenario. Walking through it like that really shows how the components interact.
Yeah, that definitely clarifies it. Now, when auditors are doing this risk assessment, SA 315 mentions 2 main levels they look at.
Correct. 2 key levels. First, the overall financial statement level. These are risks that are pervasive. They could affect many different parts of the financials. Think big picture stuff, like a really poor control environment. The tone at the top is bad. Maybe management integrity is questionable. Or significant going concern problems. These cast a shadow over everything.
Okay, the whole picture. What's the second level?
The assertion level. This is much more specific. It relates to management's claims, their assertions about individual classes of transactions, like sales, expenses, account balances, like inventory, receivables, or disclosures, the notes.
Assertions. Okay. Why are these so important? Why break it down that far?
Because it helps us pinpoint exactly where a misstatement might happen and what kind of misstatement it might be. SA 315 gives us categories of these assertions. Think of them as different angles to look at the numbers from.
Angles. Like lenses.
Yeah, lenses is a good way to put it. For transactions and events during the period, like your P&L items. Occurrence. Did the recorded sale actually happen? Is it real? Completeness. Were all the expenses that should have been recorded actually recorded? Is anything missing? Accuracy. Are the amounts right? Is the calculation correct? Cutoff. Was it recorded in the right period? December sales in December. Classification. Is it in the right account? Expense versus asset.
Okay. Those make sense for transactions. What about balance sheet accounts?
For account balances at period end. Existence. Does the asset actually exist? Is that inventory really in the warehouse? Rights and obligations. Does the company own the asset? Is the liability really their obligation? Completeness. Are all assets and liabilities recorded? Any missing loans? Valuation and allocation. Is it recorded the right amount? Is inventory valued correctly considering obsolescence? Are allowances needed?
Right. Valuation seems critical there. And the last category.
Presentation and disclosure of the notes. Occurrence and rights and obligations. Do the disclosed events pertain to this company? Completeness. Are all the required disclosures included? Classification and understandability. Is it presented clearly? Can a user understand it? Accuracy and valuation. Is the information in the notes correct and properly valued?
Wow. Okay. So you really need to think about potential problems from all those different angles for each major area.
Exactly. It's not enough to just say receivables exist. We need to know they exist, the company has the rights to them, all of them are recorded, and they're valued correctly, meaning are they collectible?
That detailed breakdown is super helpful. And once you've identified risks using these assertions, the next step is the risk response, right? SA 330. Designing procedures to tackle those specific risks.
Precisely. And here, it's crucial to remember the difference between error, an unintentional mistake,
Right.
and fraud, an intentional act to deceive.
Right. Accident versus deliberate.
Yes. And the auditor's job is to get reasonable assurance against material misstatements caused by either one. The response usually involves a mix of procedures. Tests of controls, checking if the company's own controls are working effectively. and substantive procedures directly testing the numbers, the balances, the transactions to find misstatements.
Okay, let's look at Test Your Understanding 1. An insurance company requires a special committee, DCC, to appoint surveyors for claims over 30 lakhs. But the auditor finds 5 cases where the divisional manager did it instead. The auditor initially thought risks were low. How does this finding change things?
It changes things significantly. This is a clear deviation from a prescribed control. The control wasn't operating as designed.
So the initial low-risk assessment was wrong.
Potentially, yes, specifically for control risk related to large claims authorization. Finding these deviations means the auditor has to reassess. Control risk is likely higher than initially thought. This increases the overall risk of material misstatement for those large claims.
And what's the consequence for the audit plan?
The auditor has to modify their procedures. They might need to do more substantive testing on those large claims handled by the divisional manager. Maybe look at more claim files, scrutinize the settlements more closely, perhaps even check the surveyor's qualifications or independence more thoroughly. The nature, timing, and extent of their procedures need to change in response to the identified control weakness.
Got it. The finding directly impacts the work they do. Let's try Test Your Understanding 2. A first-time audit of an NGO focused on upholding democracy. Last year, unaudited, small scale. This year, big donations, foreign funds, crowdfunding, plus new government powers to cancel their foreign funding certificate, FCRA. And they operate in a politically sensitive area. Wow. Where do you even start assessing risk here?
That is a rich scenario. You break it down using the risk components. Let's start with inherent risk, IR. Political social field, inherently risky. Scrutiny, pressure, potential for controversy, high IR. Crowdfunding, complex tracking, donor transparency needs, potential for errors or mismanagement, higher IR. Foreign funds, huge compliance risk, especially FCRA in India. Non-compliance could shut them down, very high IR. Prior year unaudited, massive IR, no baseline, unknown errors carrying forward, new FCRA cancellation power, significant immediate regulatory risk, adds to the already high IR.
Okay, so inherent risk is high across the board. What about control risk?
CR. Given they were small and grew fast with these new funds, it's highly likely their internal controls haven't kept pace. They probably lack formal, robust controls needed for this scale and complexity. Small organizations often rely on formal stuff that just doesn't work when things get bigger, so control risk is likely high.
Weak controls for complex operations. And detection risk, DR, the rest we miss.
As a first-time auditor, DR is inherently higher too. We don't know the organization's quirks yet, the specific nuances of their programs or funding streams. We need to be extra diligent in our planning and procedures to understand them thoroughly and reduce the chance we miss a material misstatement or compliance failure.
So high inherent risk, high control risk means detection risk needs to be set.
Very low, which translates to a much more extensive, careful, and possibly time-consuming audit. We need to gather a lot more evidence.
Okay, let's pivot now. We've talked a lot about the auditor assessing risk. Now let's look at the entity's side, their own defenses, their internal control system. SA 315 defines this pretty broadly, doesn't it? It sounds like it's really management's baby.
It absolutely is. SA 315 defines it as the process designed, implemented, and maintained by governance, management, and staff to provide reasonable assurance about achieving objectives. And those objectives are broad. Reliable financial reporting, effective and efficient operations, safeguarding assets, and complying with laws and regulations.
So the nature of it is a process. Policies.
Yes, it's a dynamic set of policies and procedures. It's management's responsibility, fundamentally. And it's built around managing the significant risks the entity faces in its operations, compliance, and reporting. It's not a static manual on a shelf. It's meant to be a living, breathing system.
And the scope. Does it cover everything the business does?
Potentially, yes. It can include administrative controls like production methods or quality control. But for us as financial auditors, our main focus is narrower. We're concerned with the controls that directly impact the financial statements and their underlying assertions, controls over financial reporting, asset safeguarding, fraud prevention, accuracy of records.
Okay, so within that financial audit scope, what are the specific objectives management is trying to achieve with their accounting-related controls?
SA 315 and our source material lay out some key goals for the accounting system controls. Make sure transactions happen only with proper authorization. Record transactions promptly and accurately. This is crucial for timely reporting and knowing what assets you have. Safeguard assets and records from unauthorized access or theft. Periodically check assets against records like counting inventory and sort out any differences. And the big picture goal, ensure every transaction is complete, valid, accurate, properly valued, recorded on time, posted correctly, classified right, summarized appropriately, and disclosed properly. That's the foundation of trustworthy financials.
That's quite a list. To achieve all that, the COSO framework, which our standards use, breaks internal control down into 5 key components. Can you walk us through those? What are the pillars?
Absolutely. Think of these 5 as the essential building blocks. First, the control environment. This is the foundation, the tone at the top. It's about the organization's ethics, integrity, competence, management philosophy, organizational structure, how authority is assigned. Basically, the overall control consciousness. Test Your Knowledge 10 hits this perfectly. Controls are only as good as the integrity of the people using them. It's the ethical bedrock.
Okay. Tone at the top, number 2.
Second, the entity's risk assessment process. This isn't the auditor's risk assessment, but management's process for identifying their business risks relevant to financial reporting. How do they spot risks, estimate their significance, decide how to manage them? Things are always changing. New people, new IT systems, rapid growth, new regulations. Management needs a way to stay on top of these emerging risks.
Right. Management needs to be proactive about their own risks.
Right.
Third component.
Third, control activities. These are the actual policies and procedures put in place to ensure management directives are carried out and risks are mitigated. These are the specific actions. We often categorize them. Performance reviews, like comparing budgets to actual results. Think of test your understanding for, analyzing sales targets versus actuals, figuring out why there's a difference, taking action. That's a performance review control. Information processing, controls over IT, application controls like checking data entry, and general IT controls like restricting access to systems. Physical controls, locking up assets, controlling access to warehouses or server rooms, periodic counts. Segregation of duties, this is a huge one. Making sure different people handle different parts of a transaction, authorizing, recording, custody. Prevents one person having too much control.
Okay, actions taken to manage risk.
Fourth is the information system and communication. This covers how transactions are identified, recorded, processed, and reported. It includes the accounting system itself, but also how the company communicates roles and responsibilities. Think policy manuals, accounting guides, memos. Quality information and clear communication are vital.
Makes sense. And the final pillar.
Fifth, monitoring of controls. This is management's process for assessing whether controls are actually working effectively over time. Are they still relevant? Are people following them? This includes things like regular management reviews, for example, reviewing bank reconciliations promptly, evaluations by an internal audit function, and even listening to feedback from customers or regulators. Without monitoring, even good controls can become outdated or ineffective.
That framework is really helpful. But you mentioned earlier, no system is perfect. There are limitations of internal control. Why can't we ever get absolute assurance?
It's a critical reality check. Internal control provides reasonable assurance, not absolute. Key limitations include cost versus benefit. Management has to weigh the cost of a control against the benefit. Some controls just aren't worth the expense. Focus on routine. Most controls are designed for normal, everyday transactions. They might not catch unusual or one-off events effectively. Human error. People make mistakes. Carelessness, distraction, poor judgment. It happens. Collusion. 2 or more people working together can often bypass controls designed to stop a single person. Management override. Management is often in a position to override controls, either mistakenly or deliberately. Manipulation. Management might manipulate estimates or judgments within the financial reporting process.
Right, those are important reminders. So thinking practically about the structure of internal control, how do companies implement these ideas? What are the key structural elements?
Segregation of duties is absolutely fundamental in practice. You need to split responsibilities so that no single person can initiate, authorize, execute, record, and have custody of the assets related to a transaction. You want to separate authorization, execution, custody, and record keeping.
Like in those examples, Test Your Knowledge 6, the hospital where one person handles inventory inflow, outflow, and purchases and records.
Exactly. That's a massive failure of segregation.
Yeah.
One person controls everything related to inventory. Huge risk. Same with Test Your Knowledge 12, where one person handles sales ledger and cash receipts. You absolutely want to separate handling cash from recording receivables. Other practical things include rotating duties periodically and ensuring staff take compulsory leave makes it harder to conceal ongoing fraud.
Okay, segregation is key. What else?
Authorization of transactions. Clear delegation of authority. Who can approve what, up to what limits? Ensures transactions fit company policy. Adequacy of records and documents. using pre-numbered documents, ensuring timely and accurate recording, proper classification, protecting records. Good records are essential for accountability and safeguarding of assets. Things like locking up valuable assets, restricting access to inventory or sensitive data, and periodically reconciling physical assets to the records, cash counts, inventory counts. And finally, independent checks. Having someone independent review the work or the process periodically. This could be a supervisor, internal audit, or even us, the external auditors.
That leads nicely into the difference between internal check system and internal audit. They sound similar, but they're not the same thing, are they?
Not quite, though they're related. An internal check system is built into the day-to-day routine. It's where the work of one person automatically cross-checks or complements the work of another as part of the normal workflow. Think of one clerk preparing a payment voucher and another independently reviewing the supporting documents before approval. Its main goal is prevention and early detection of errors fraud within the routine process.
Okay, built-in continuous checking. How is internal audit different?
Internal audit is typically a separate, independent function within the organization. Their job isn't usually part of the daily transaction processing. Instead, they appraise the effectiveness of the entire internal control system, operations, and compliance. Management usually defines their scope. They might review specific processes, test controls, investigate issues, and report findings and recommendations back to management and the audit committee. Like in Test Your Understanding 3, where internal audit finds the system, books purchases based on invoice date, not goods receipt, potentially misstating inventory and causing tax issues. Internal audit identifies that design flaw and recommends fixing it. They evaluate the system. They don't typically operate it.
Okay, so we understand the entity's system. Now, back to the external auditor. What's the specific purpose of reviewing the system of internal controls from our perspective? Why do we spend time on it?
It's crucial for planning our audit effectively. Two main reasons. First, to decide how much we can rely on the client's controls. If controls are strong and working, we might be able to reduce the amount of direct substitute testing we need to do. Second, to identify weaknesses. Finding weaknesses tells us where the risks are higher, so we know where to focus our audit effort. We might need to increase the nature, timing, or extent of our substantive procedures in those weak areas.
Is this review just done once at the beginning? And what if we find problems?
It requires judgment. For a continuing audit, we focus on changes since last year, maybe doing a full refresh every 3 years or so. For a new client, it's a major focus up front. And yes, if we find weaknesses, especially significant ones, we have a professional duty to communicate them to management and those charged with governance, usually in writing. We explain the weakness, its potential impact, and suggest improvements. We also follow up later to see if they've fixed it. It's part of our role to help improve their control environment, not just find fault.
Right, that communication is key. So what techniques do auditors use to actually evaluate these controls? What tools are in the toolkit?
We have a few common tools. One is the Internal Control Questionnaire, ICQ. This is basically a list of standardized questions about controls in different areas like purchasing or payroll, often designed so a no answer flags a potential weakness.
Who answers it?
Ideally, the client staff or management. In practice, often the auditor sits down with them and fills it out based on discussion, as it can be time-consuming. A good ICQ assumes certain basics, like segregation of duties exists. It's very useful, especially for first audit, to get a baseline understanding.
Okay, questionnaires. What else?
We might use a checklist. This is similar, but often more geared towards the audit staff themselves, a list of specific things to check or verify during fieldwork. The key difference from an ICQ might be that a checklist often requires the auditor to state if a weakness found is material, demanding more judgment than just a yes-no answer. Think of specific checks for a cashier. Do they open mail, sign checks, take leave, balance cash daily? Very operational questions.
More of a verification tool for the audit team? And the third one?
The flowchart. This can be incredibly powerful. It's a visual diagram showing the sequence of operations and the flow of documents within a system.
Why is that so useful?
Because you can see the whole process at a glance. Where documents start, who handles them, where copies go, what checks are performed, where things are filed. It gives a great overview, but can also capture lots of detail. It really helps to visualize how the system works, or doesn't work.
Can you walk us through that sales and trade receivables flowchart example from the source? How does it actually reveal strength and weaknesses? Let's break down the order receiving, dispatch, and billing parts.
Okay, imagine we map it out. Order receiving. Gets orders, mail phone salesman. Creates numbered sales advices, enters an order book, sends copies to dispatch, gets a copy back from dispatch later to confirm shipment and close the loop in the order book. Dispatch gets sales advice copies, arranges shipment, initials advice to confirm dispatch, sends one copy back to order receiving, one with goods, packing slip, one to billing, one with driver for acknowledgement. Billing gets advice copy from dispatch, matches it, maybe, prepares numbered invoices, prices them, records advice number on invoice, sends copies out, customer accounts receivable, etc. Handles credit notes too.
Okay, I can picture the flow. Now, what weaknesses might jump out from that chart based on the source?
Several potential issues become visible. Is there a check that all advice forms created by salesmen actually make it to order receiving? Maybe orders are getting lost. Weakness. Orders taken by phone. Is anyone checking the customer's credit before raising the sales advice? Huge risk of selling to bad credit risks. Weakness. Relatedly, no mention of prior credit approval. Weakness. Is there a check to ensure every advice copy sent from dispatch actually reaches billing? If not, goods could be shipped but never invoiced. Major weakness, lost revenue. Who checks the pricing, the calculations, the additions on the invoices, and credit notes? If no one does, errors or fraud could easily occur. Big weakness. Credit notes are the supporting documents properly reviewed and authorized. Credit notes reduce revenue, so they need tight control. Weakness if unclear.
Wow. Okay, mapping it out really highlights the gaps. Does it show any strengths too?
Yes, absolutely. The flowchart might clearly show good numerical control over the sales advices and invoices, pre-numbering. Strength, a permanent order book tracking all orders. Strength, matching the customer purchase order to the sales advice if that happens. Strength, the dispatch head initialing advice is a clear point of responsibility. Strength, clear records distinguishing local versus outstation deliveries. Strength. So the flowchart gives you that balanced view. You see the controls that exist and where the holes are.
That makes the value of flowcharting crystal clear. Now, when auditors find these weaknesses, these holes, SA 265 talks about communicating deficiencies. How do we define these, and what exactly do we need to communicate?
Right, there's a distinction. A deficiency in internal control is basically any flaw a control is missing, or it's designed or operating badly so it can't prevent or detect misstatements promptly.
Just any flaw.
Well, then there's a significant deficiency. This is a deficiency, or the combination of them, that the auditor judges to be important enough that it needs to be brought to the attention of those charged with governance, usually the audit committee or the board. It's serious enough for the top level to know about.
And the auditor must communicate these.
Yes. Significant deficiencies must be communicated in writing and on a timely basis to those charged with governance. The communication needs to describe the deficiency clearly, explain its potential impact, what could go wrong because of it, and give enough context for them to understand its significance. We also usually communicate them to management. That old Catterson and Ltd. 1937 case is the classic example. The auditor told the client in writing the controls were bad, the client didn't fix them, fraud happened, but the auditor was found not negligent because they had properly communicated the weaknesses. That letter of weaknesses is vital protection.
That case really drives the point home. Let's apply it. Test your understanding 5. A company's controls might not be catching insurance premiums that are due. Why is that likely a significant deficiency, and what should the auditor tell them?
That's significant because the potential consequence is huge. If assets aren't insured because premiums weren't paid, the company could face catastrophic losses from, say, a fire or flood. A deficiency is significant based not just on whether something has gone wrong, but the likelihood it could go wrong and the potential size of the misstatement or loss. Here, the potential loss magnitude is very high.
So what's the communication?
The auditor writes to governance, describing the problem, example, lack of system to ensure timely payment of insurance premiums, explaining the potential effect, risk of uninsured losses, potentially impacting financial stability, and providing context so they understand the urgency. It needs to be clear, written, and timely.
Got it. And just briefly, auditors operate within a world of global internal control frameworks. Can you quickly mention the main ones?
Sure. The big ones you hear about are COSO, very common, especially in the U.S. Comprehensive, covers operations, reporting, compliance using those 5 components we discussed. COBIT, focuses specifically on IT governance and controls. Super important now with everything being digital. Helps align IT with business risks. Turnbull Report, UK, guidance for UK company directors. Emphasizes a risk-based approach and an annual review by directors of all types of controls. Sarbanes-Oxley, SOX, Section 404 U.S. Huge impact on U.S. public companies. Mandates documented, tested internal controls over financial reporting, ICFR, requires management assessment, and requires the external auditor to issue a separate opinion on ICFR effectiveness. These frameworks just show how globally important robust internal control is seen to be.
Okay, this is where the rubber meets the road, especially for anyone listening who's facing those case-based exams. Here's where it gets really interesting. We're going to apply everything materiality, risk, controls, assertions to an exam-style scenario. The Find Me Limited case study. So, Find Me Limited makes bicycles. We've got 2 years of data, key facts. Revenue jumped 40% in year 2, 35,000 lakhs versus 25,000 lakhs. Gross profit is up too. But no major plant capacity increase. Instead, they cut their dealer network and shifted heavily to direct online sales, which they say is going well. We need to use analytical procedures to assess risk. Ready to tackle the questions?
Absolutely. Let's dissect these anomalies and link them straight to audit risks and assertions, thinking like an auditor planning the engagement.
Revenue up 40%, no plant capacity additions. Most appropriate statement. The source says, A, there is audit risk that revenue from operations is overstated.
Okay, 40% growth sounds good. Why the immediate suspicion of overstatement? What's the trigger?
It's the no additions in plant capacity paired with that huge revenue jump. That's the anomaly. How do you sell 40% more bikes without making significantly more bikes or having a massive inventory rundown? While the shift online could improve things, a 40% jump is steep. It immediately flags a risk related to the occurrence and accuracy of revenue. Did these sales actually happen? Are they recorded correctly? Is there premature recognition? Fictitious sales. We need to dig deep here. It raises questions about the sustainability and reality of that growth figure.
Right, the physics don't seem to add up with that investigation. Okay, question 2. Operating expenses are identical for both years. Most appropriate statement. The source picks. D. There is audit risk that previous year figures have been presented in place of current year figures. This one seems almost too obvious. Expenses being exactly the same with 40% more revenue and a totally different sales model. Highly unlikely.
Extremely unlikely. It's a massive red flag. Operating expenses staying perfectly flat while revenue surges and the distribution method changes dramatically. It defies logic. This points strongly to a risk of misstatement affecting accuracy and completeness of expenses. It could be a simple copy-paste error in preparing the drafts, or potentially something more deliberate to inflate profits. The auditor must find out why they're identical.
Okay, makes sense. Question 3. Trade receivables turnover ratio increased, meaning collection slowed down, from 1.44 months to over 2 months, despite shifting to online distribution. Most appropriate statement. Source says D. Turnover should have fallen. Possible dealers not meeting commitments. Audit risk that trade receivables could be overvalued. This feels backwards, right? Online sales usually mean faster payments, so turnover should improve, decrease in months, not worsen.
Exactly, your intuition is spot on. Direct online sales, often paid by card, should speed up collections, reducing the turnover period. So seeing it increase, slow down, is highly counterintuitive and a major anomaly. It strongly suggests problems, likely with collecting from the old dealer network being phased out. This points directly to an audit risk impacting the valuation and allocation assertion for receivables. Are these old balances actually collectible? Is the bad debt provision adequate? There's a significant risk receivables are overstated or overvalued.
Got it. The change in business model creates a specific risk here. Question 4. Gross profit ratio increased by 3%. Most appropriate statement. The source points to D. There is audit risk that cost of sales may not be completely recorded. Higher gross profit sounds good. Why the skepticism? What's the potential issue?
Auditors are paid to be skeptical. An increased GP ratio is nice for the company, but we need to understand why. Is it higher prices, lower costs? If there isn't a clear, verifiable reason, like documented price increases or proven production efficiencies, a rising GP ratio could signal that cost of sales is understated, hitting the completeness assertion for expenses. Maybe some costs were incorrectly capitalized, or possibly closing inventory is overvalued, which would reduce COS and increase GP. Or maybe expenses that belong in COS are elsewhere. We need to verify the reason for the margin improvement.
Okay, need to validate the good news. Last one, question 5. Inventory turnover ratio increased, meaning inventory sits longer, from 2.88 months to about 3.42 months. Most appropriate statement. Source choice is C. Revenue jump may need more inventory, but risk some inventories with dealers could be obsolete. Audit risk inventories may be overvalued, so inventory is moving slower even though sales are up. How does that play out with the business model change?
It's another interesting tension. Higher sales might justify holding more inventory, leading to a longer holding period if inventory increases faster than sales. But the shift away from dealers is key. What about the inventory that was tailored for or held by those dealers? Is it still sellable through the online channel? This statement captures both possibilities. Yes, maybe they needed more stock for growth, but there is a very real risk that old dealer-focused inventory is now obsolete or slow-moving. This creates an audit risk related to the valuation and allocation of inventory. It might be overvalued if proper write-downs for obsolescence haven't been made.
These Find Me LTD questions really tie it all together using analytical procedures to spot anomalies that point to specific risks and assertions. Great practice. Let's quickly revisit a few other scenarios from the source material just to hammer these points home. Remember, test your knowledge. STLTD risk-based audit. Growing tile company, planning expansion, focused on controls. If you're advising them on a risk-based audit, what are the core steps again?
It's that systematic process. 1. Understand the entity, its environment, including its internal controls. 2. Assess the risks of material misstatement both overall and at the assertion level. 3. Respond by designing and performing audit procedures, tests of controls where appropriate, and substantive procedures tailored to the assessed risks. Understand, assess, respond.
Perfect. And test your knowledge 9, YCO LTD entertainment centers, cash collection across 5 sites. Cash is always risky. What are some specific practical controls you'd want to see there?
For cash, you need tight controls. Serially numbered tickets, centralized ticket sales, daily reconciliation of cash collected to tickets sold by someone independent, daily banking of all cash, canceling tickets at entry to prevent reuse, controls over advanced bookings and any discounts freebies, and critically, surprise cash counts and checks by internal audit or management, layer upon layer of control for cash.
Right, multiple checks. Finally, test your knowledge 11, step for risk identification. How does the audit team actually start finding those risks? What are the initial actions?
It starts with information gathering, making inquiries, talking to management, internal audit, other relevant staff, performing analytical procedures, looking for those unusual trends and ratios like in the Find Me case, and doing observation and inspection watching processes, looking at documents, touring facilities. Plus, a really important step is the engagement team discussion, talking amongst ourselves about where the entity might be susceptible to misstatement. It's a mix of talking, analyzing, and observing. #Advertisement.
So wrapping this all up, what does this mean for you, especially as you prep for that exam? We've covered a lot of ground: the centrality, materiality, the components and calculation of audit risk, the structure and importance, but also limitations of internal controls. We've seen the auditor's methodical approach, understand, assess, respond, and crucially, how these concepts aren't just abstract definitions, but tools you use to analyze real situations, like the case studies we walked through. Hopefully, you're feeling more comfortable with the terminology and how to apply it. That was the goal.
Absolutely. And thinking about all this, especially the limitations of internal control and how fast business changes today, it makes you wonder, doesn't it? Given that no system is perfect and risks are always evolving, how critical is that continuous, perhaps even automated or AI-driven monitoring of controls? Not just for financial reporting, but for the long-term health and sustainability of the entire organization. Something to think about beyond the exam syllabus.
That's a great thought to leave our listeners with. We hope this deep dive has been valuable, given you that detailed understanding, and maybe even spark some new questions. Keep digging, keep learning.
And good luck with your preparations. We'll catch you on the next deep dive.